Hello everyone. Welcome to today's video. Today we're going to be talking about income statement, and it's the first topic in the whole coursework of finance for non-finance professional. My name is Bilal Ghattis and I'm going to be your instructor for today. We're going to start off this video by talking about the agenda and what you guys should expect out of watching this video. First of all, we're going to be talking about the definition of an income statement. Then we're going to move on to some basics that has to do with accounting, but I'm going to be talking about them in a very simplified manner. And then we're going to move on to discussing the big important question, which is what's the difference between income and cash? Does my income equal to my cash? And why does my income not equal to my cash? Then we're going to move on to discussing the skeleton of the income statement, how the income statement is set and how the skeleton actually looks like in most cases. Then we're going to move on to discussing the types of income and expenses you should expect to see in an income statement. Then we're going to talk about two different formats of an income statement that are very common and very familiar. And then we're going to end this video by talking about few ratios that I believe everyone should be aware of, even if you don't have to calculate them, but you need to understand what they actually stand for. So to start off, guys, income statement. What's an income statement? Well, basically, it's a statement that shows the income that you have earned and the expenses that you have incurred for a certain period of time. And please focus on period of time, because an income statement has a period of time. So basically, it can be for a day, for a week, for a month, for 1 quarter, semi-annual, or annual. Now, definitely, the most common time span of income statement that you guys might see or might hear of are for 1 quarter, semi-annual, and basically annual because of requirements, especially in the stock markets or requirements as per the company policy. However, yes, you can generate an income statement for 1 week, even 1 day. Now, different names for income statement could be profit and loss statement, statement of revenue and expenses, or basically the most common one, which is the income statement. Now, what are the key figures that you should expect to see? In the income statement, you should expect to see figures like revenues, cost of goods sold, depreciation expense, tax expense, SG&A. Now, to go over some basics before we get into the details of the income statement. It's important to understand that every revenue should be related to something that initiates it. So I'm going to be talking in a very simplified manner, and I'm going to try not to get too technical. If we have a store and we manage to sell 1,000 items of good A for $1 per piece, and we have also agreed to give the client that has bought those items a payment term of 90 days. So basically, if today is January 1st, today we have sold, but today we did not earn any cash. So we need to understand that not always do my income equal to my cash because of the time and the payment terms. So here, even though I did not collect any cash, but the sale process has completed, which means that I should record an income by the amount that I have sold. However, my cash balance will not change right now because I did not collect any money. Thus, the cash effect will show later on. However, my income effect will show as of January 1st, but collection is something else. So please start to separate between the two terminologies, cash and income. Same goes to payments, guys. So imagine that for us to be able to produce the 1,000 units that we have sold earlier, we need raw material from the supplier. So we put an order, and the order is worth $500. However, the supplier gave us 120 days payment terms. So if today is January 1st, it means that today The order is completed. We got the goods. He gave us an invoice for the goods, which means that a paper that says we have bought those amount of goods for this amount of a dollar, and we have to pay in 120 days. The moment I get the invoice and I put the invoice in my accounting system, the expense is recorded. So on January 1st, I will record an expense. However, I did not pay any cash yet. So in the income statement, guys, you will see the expense recorded on January 1st, and it will be within the income statement. However, there will be no cash effect up until I decide to pay for the goods that I have purchased. Again, differences between income and cash. Thus, it is very important for you guys to differentiate between what an income is and what is cash. You hear a lot of times that your manager is wondering, why isn't my net income equal to my cash? Your income statement shows $10,000 of profits, but why don't I have those $10,000 in my hands? There's a lot of reasons behind it, but I have tried to pick the most important ones, and I will try to simplify them to try to scratch your brain and think about it so that you can really understand where the differences come from. Example 1, it talks about selling units, right? But not collecting now. The thing that we have discussed earlier. If you sell something right now, it's an income. But if you have provided the client with a payment term of 90 days, it means that your income right now will increase, but cash will increase in 90 days, right? So the cash position now remains the same, but in 90 days, it will increase. Same goes for purchases of raw material from a supplier. If you purchase raw material worth of $500 right now, and you have to pay later on, expenses will increase. However, the cash will remain the same right now, but in 30 days, the cash will decrease. You see the mismatching. If you have decided to pay $3,000 for a supplier right now for an expense that you have recorded earlier, what that means is your cash balance will decrease right now, but there will be no effect in the income statement because I have already recorded the expense earlier. Same goes with collection. If you have received $500 from a customer right now for goods that you have sold to them earlier, like 2 months ago, it means that your cash balance will change right now, but there will be no change in the income statement because you have already recorded the income earlier when and on the day that the client has purchased some of your products. Moreover, if you have paid $1,000 to purchase a car or $10,000 to purchase a car and the car is for the company, this is not an expense. Whenever you purchase a car, which is something financially valuable, it has a certain financial threshold. It might be $1,000, it might be $1,500, it might be $3,000. This depends on the company policy and the accounting and finance policies and procedures. But simply speaking, and in a very simplified manner, if you purchase something that has a good value in it, it means that it is not an expense. It is what we call a fixed asset. So if you buy a car for $10,000 and you pay them cash, it means that your cash balance will go down because you actually paid, but your income statement will only be affected by the amount of depreciation of this car. So purchasing an asset, which you classify as a fixed asset, will not show up in the income statement. What will show up is the part of depreciation that is related to this asset. And for more information, please go and visit my balance sheet and understanding balance sheet for finance for non-finance professionals. Moreover, imagine that you have purchased an insurance policy and you've paid $1,500 for the whole year and you've paid it cash. This is what we call a prepayment, which means, guys, that you paid $1,500 cash, so your cash decreased, but you do not put the whole amount as an expense in your income statement. Why? Because you have not made use of the whole insurance policy yet. The insurance policy is for 1 year, which means that as time passes by, as you're gonna go and record the monthly insurance expense on your income statement. So to be fair to yourself and your company, you're not gonna record the whole expense in a one shot. You're gonna segment it monthly, and you're gonna start taking out those insurance expense based on a monthly period because the insurance policy has a duration of 1 year. Vice versa, if you have a company and you have sold a certain service to a client and you have collected $5,000 cash, but you did not provide any service yet, this will result in the following. Whenever you get the $5,000 cash, your cash balance will increase because you have cash in your hands right now. However, because you did not give any service yet, I cannot record this as a revenue. So basically, you've received cash for something that you did not do. If you think of it in a personal perspective, you're going to feel that you have a liability on your shoulders, which is the same in accounting. If you get a certain amount of money for a service that you did not give, it's a liability up until you start giving this service. So the first headline for the mismatch between income and cash is timing. The second headline is what we call the non-cash charges. Non-cash charges are of many types, but I'm going to discuss the most common one, which is depreciation, guys. So basically, depreciation, guys, is whenever you buy a car, and let's say the car is worth $5,000, and the lifetime of the car is 5 years, it means that in every year, you're going to deduct $1,000 from your statements. But imagine that you do purchase the car and it's for 5 years and you have $1,000 depreciation expense. But whenever you incur the depreciation expense and record it, do you go to a certain party and pay that $1,000? You don't. You don't do that because you're trying to be fair to yourself and your book, and you're decreasing the value of the car as time passes by. But that does not mean that when you record the depreciation expense, you're going to go and pay it to someone. So this will also result in a mismatch because you're going to have a depreciation expense in your income statement, but your cash will not be affected. So another mismatch. One final reason behind a mismatch, which is also very common, is whenever you have cash on hand and you go and you pay a certain installment for a loan. When you pay an installment on a loan, it will not affect your income statement. So what you do is you have cash, you pay cash, cash balance will decrease, but nothing will show up on the income statement. Then this means that there is a mismatch. So when a manager asks you, why aren't the figures matching? Why do I have a profit of $10,000 but I do not have them on hand? You can now explain some of the reasons behind it. Moving on, guys. So for us to reconcile the difference between income and cash, we do what we call the cash flow statement, which will also be a video that should be coming soon for the series of finance for non-finance professionals. So whenever you want to reconcile and explain why has your income statement resulted in this amount of ending cash balance, we do what we call the cash flow statement. Now the skeleton of the income statement. The income statement in a very simplified manner should be segmented into 3 parts. The top part, the major part, the middle part, and the final lower part. The top part always shows the major sources of income and expense. So if we're talking about F&B industry, we're talking about the sales of food and beverages and the cost of food and beverages, cost of production, cost of labor. Then in the middle part, we talk about the expenses that we incur in order for us to continue our operations, the expenses that drive our F&B operations other than that of raw material and labor that go into the production of the food itself. And finally, we have the other expenses and other income that are not related to operations. And they usually come in the lower part. Thus, if you want to see skeleton of different companies in different industries, we need to understand that income statements for companies operating in different industries will never look the same. Because at the end of the day, if I'm looking at a bank, the bank's major operations is from interest, whether it's interest income or interest expense that the bank pays for its clients, alongside with commission, fees, foreign exchange. But if we look at F&B, it is the sales of food and beverage. It is the cost of raw material and direct labor that goes into the food and beverage. If we look at an insurance company, we're looking at a company that sells insurance premium and buys reinsurance premium. So if you want to look at how they look like, the skeletons from a first view will look a bit different. But if you really want to understand them, you need to understand how the company operates. And if you understand how a bank operates and how an insurance company operates, and try to match the totals and what the totals stand for, you're going to see that they are very familiar in the way that they are sorted out. Thus, we're going to talk about the segmentation types of an income statement, and we're going to talk about the nature types of the items that you will find in the income statement. Going back to the main drivers of an income statement, as I've said, the top line is always the main driver of the whole business. So whether it's an income or it's an expense. And here you have to understand something that is very important. If we're looking at a bank, an interest income is a top line item for a bank. But interest income is not always top line for all companies, because interest income might be the bottom line for F&B. So because interest is the main driver of a bank, interest is not the main driver of a food and beverage company. So you're going to find it in the lower part of the income statement. So have that in mind. So examples of top line: interest income for a commercial bank, food and beverage sales for a restaurant, investment income for investment company, consulting service for consulting company, apartment sales for real estate company. As for expenses, because interest income is the main driver of income, interest expense is the main driver of expenses. Same goes for F&B, cost of goods sold, and this is important. Whenever we have a company that is producing a good that it is selling, you need to understand that the cost of this item should never be only the raw material, because actually you have people that are working on the production of the item. And this is what we call the direct labor. So they go into the top line of the cost, which is the cost of goods sold. So here the cost of goods sold is segmented into raw material, direct labor, and direct overheads. For more information, please go to my costing for finance for non-finance professionals. Investment fees, payroll expenses, and finally, the apartment cost for the real estate company. As for the middle section are the income and expenses that support the operations, and this is what we call operating expenses, operating income, and below are a list of some. And finally, we're going to talk about the lower part or the bottom part of the income statement, which is what we call the other income and the other expenses. So basically, guys, you need to understand the terminologies of the total. Whenever we deduct the top parts from each other, we're going to have a key figure that is called the gross profit. So the gross profit is how much profit we made out of the main drivers of the business. The operating profit is how much profit did we make after adding and subtracting the main drivers of the business and other operating drivers like other operating income and operating expenses. And finally, the net income is how much is left after deducting and adding everything that falls within the period of this income statement, including taxes, of course. So guys, we have discussed the segmentation of the income statement. Now it's time to talk about certain expenses that we should expect to see in an income statement. The first type is what we call the NCC, the non-cash expenses or the non-cash charges. Two of the most common examples are depreciation and provision for doubtful debt. Now, what is depreciation expense? I've talked about this earlier, but I'm going to talk about the details of this, and I'm going to use the whiteboard. So imagine, guys, that you have purchased a car for approximately 10K, and the lifetime is 5 years. So that means that you've paid for a car which you expect to last for 5 years, not in terms of how many years it will last and then it will break down. No, but financially speaking, you should estimate a lifetime that will be fair in terms of how many years it will serve me until it becomes, of course, kind of disposable. So basically, you're going to have what we call a depreciation expense. It is a non-cash expense. It means whenever you have this expense recorded, you do not have to pay cash for anyone. But you're doing this because you are decreasing the value of the car. Same goes for provision, guys. Let's say that you have debt on your statements of $10,000 from your clients. So basically you have collectibles, not debt. And you believe that $5,000 out of the $10,000 will not be collected, or there's a possibility that they will not be collected. In order to represent how much you have receivables in your statements, you should adjust the $10,000 because the $10,000 is not fair, right? It's not a fair figure because you know that there's a big possibility that you're not going to be able to collect them. So you need to do some kind of an adjustment. So we do what we call a provision. Provision means that you go and you record a non-cash expense on your income statement to reflect the possibility of you not being able to collect the $5,000. So we go and we record it in our income statement, and we do not have to pay anyone any cash for that. We do it for the sake of adjusting how much people owe us to be fair and represent our statements in a logical way, so that if an investor reads our financial statements, he will see that I need to collect $5,000 from my client only. If I put $10,000 and I did not take any provision, it's as if I'm being misleading. I'm telling that I have $10,000 to collect, but in fact, I know that there's a big possibility that $5,000 will not be collected. And this is what we call, guys, the non-cash charges. Okay. One more example is the non-cash gain or loss. So imagine, guys, that the car that we've talked about, we have this car and we have used it for a few years, and now the value of the car in our statements is $2,000. Now you have decided, or management has decided, to sell this car. So the value on our books, the carrying value of the car on our books is $2,000, or the book value. However, we have managed to sell the car for $1,000 in the market. So this is the sale price. What happens here is the following. If we have a car that is worth $2,000 on our books, however, we sell it for $1,000, we have some kind of a loss. because the books say that we have 2,000, but what we collected was 1,000. So this means that there's a mismatch of $1,000 that we call a loss. So we record a loss of sale of fixed asset, which means that a loss has been incurred because we've sold the car for less than its book value, and the amount is $1,000. But did we actually pay this $1,000 to anyone? No, we didn't. We collected $1,000. So this is another item that we add on our income statement that creates a mismatch between the cash that we have on hand and the net result of the income statement. So in this case, our cash increased because we collected 1,000, but our net income decreased, or our total income decreased, because we have a non-cash expense that is a loss on the sale of a car that we had earlier. Thus, guys, it is now the time to discuss the income statement formats. There are two general common way of representing an income statement. The first one is the one that we have seen earlier. So basically, you hear of words like EBITDA, EBIT, EBT, or earnings. Those words come from the second common format of income statement. And we do it this way. The second format starts with listing revenues and expenses. After that, so we put all the revenues and all the operating expenses up until we reach a figure that is called EBITDA. So revenues minus expenses will yield EBITDA, and EBITDA stands for earnings before interest, tax, depreciation, and amortization. After we get to EBITDA, we take out the D&A, which are depreciation and amortization, and we get the EBIT, which stands for earnings before interest and tax. And a way of reconciling EBIT is always comparing it to operating profit. So in most cases, guys, your EBIT, your earnings before interest and tax, will be equal to your operating profit. So we can understand by now that we are in the middle section of the income statement. So we've taken out the top and we've taken out the middle. What is left is the lower or the bottom side. Thus, we take out interest, expense. We reach to what we call the EBT because the I has been taken out. Earning before tax, we take up tax, and we will have our net profit or net loss. These are the two common formats of the income statement that you should expect to see. Now, finally, guys, before we close this video and this session, we have to talk a bit about ratio analysis. I mean, this course is for finance, for non-finance people, so I don't expect you guys to go and analyze the income statement in a very complicated manner. However, you need to understand, in general, or with a bit of details, the ratios in case someone is discussing a result for a certain company, or you're listening to the news, or you've read a certain article. So ratios for financial statements are of two types. There's the pure ratio, which comes from one statement only, or the blended ratio, which comes from combining figures of different statements for a company, like a figure from a balance sheet and a figure from income statement and cash flow statement, balance sheet and cash flow statement. This is what we call blended. For the sake of this video, I'm going to be talking about the pure ratios, which are ratios that are deducted solely from the income statement. And later on, whenever we get into more videos about balance sheet, about cash flow, I'm going to be talking about blended, and to try to blend and give you guys as much information as possible when it comes to the ratios that you should expect to see or to hear of. So the most common type of ratio for the income statement is what we call the profitability ratios. Profitability ratios show how much you are profitable in terms of your total sales as we move from one part or one segment of the income statement to another. So if you remember, we have segmented our income statement to three parts: the top, the middle, and the bottom. So we have three ratios: ratio about the top, ratio about the bottom, and ratio about the middle. The top ratio is what we call the gross margin. So the terminology is kind of the same. Gross profit, gross margin. So gross profit shows you how much profit you have made in dollars, and gross margin shows you how much profit you have made in percentage out of your total sales. So your denominator in this case for all the profitability ratios will be sales. So it will be gross profit over sales, how much in percent you have made from the top line of your income statement. Operating margin, which is operating profit by sales, how much in percent you have made out of your operations whenever you take into consideration your total sales base. Same goes for net margin. It is the net income, the net profit by sales, which means how much in percent you have generated out of your total pie of your sales. These guys are the most important ratios that finance for non-finance people or students or professionals should understand and be aware of. I would love to hear any question that you have. You can drop them in the comment, and I will be more than glad to try to help and get back to you as soon as possible. I would like to thank you for watching, and please hit that thumbs up and subscribe. Thank you guys.